Wait, what? I can do that? This is Eric Bell with Wait, what? Financial matters that matter for business and the people that own them. If you missed our previous episode, we spoke to Abdi Ahmed regarding cybersecurity and your business. It's my pleasure to have as a returning guest, David Greenberg. I joked in a previous episode on R&D tax credits that David had more letters after his name than I have in my name, but it speaks to his expertise in the out-of-the-box tradition of tax law and accounting. Today we're going to discuss restricted property trust. Thanks for being with us, David.
Thank you.
David, I want to just ask you real quick, what is a restricted property trust and how would it benefit a business owner?
It's a trust that a company will set up for the specific benefit of the shareholders, partners, slash owners, whereby you can contribute $50,000 or more a year to it to purchase life insurance for the shareholder owners, partners.
Okay, well, how does it work?
You form the trust, you contribute, let's say $50,000 to it, and then the trust goes out and buys life insurance for the benefit of the partner, owner, or shareholder.
Okay, so is this something they have to do for all the employees, or they can carve it out for specific people?
You only do this for shareholders, partners, or owners.
Okay, so you can be selective for who you might do it for. Yes. Okay, so the minimum contribution you said was $50,000. Is there a maximum?
$250,000, I think.
$250,000. Okay, that's a lot per year.
Yes. And
you have to do it for, I thought I remember reading about 5 years?
5 years.
Okay, 5 consecutive years. Now, if you do one for 5 years, can you pick it up another one for 5 years and do it?
Another employee or shareholder owner?
Yeah.
Yes.
Okay.
Yes.
But let's say you did your 5 years and you're only 50 years old. Now you're 55. You're going to continue to do the business. Could you open up another trust and do it all over again or no?
You could continue to contribute to that same trust and buy more life insurance for the shareholder owner.
Okay. Well, that's good. So it doesn't just stop in 5 years. You can continue to keep making contributions if you wanted to.
That's correct.
Okay.
You'd have to buy more insurance, presumably, but yes.
This kind of sounds to me, David, kind of too good to be true. So I got to ask you, what's the catch or what are the challenges to this plan?
The only catch to the plan is while the company gets a deduction, the owner shareholder is going to end up with 30% of whatever's contributed on their behalf being subjected to income tax. But by the same token, they get a deduction for 100%. And so so you really get a deduction equal to 70% of whatever's contributed.
Okay. Can you say it to me again real slow? So for
let's say you contributed $100,000 to the trust to buy insurance for the benefit of the shareholder or the owner. Well, the owner is going to have to reflect $30,000 of that $100,000 that was contributed as income. But if it's a flow-through entity, like an S-corp or a partnership, which most of them are, then the company gets a $100,000 deduction. The employee the shareholder owner recognizes $30,000, so that's a net deduction of $70,000.
Okay. Now, when he starts pulling from the plan, that's when he's going to pay taxes because it's a deferral?
Yeah, if he pulls from the plan, but presumably he's actually buying life insurance.
Okay.
That for his estate or for his children. And so when they die, it's not subject to tax, or you can borrow from the insurance policy tax-free also.
Tax-free basis. Wow. So he can get a deduction and basically at the end of the day, probably have a tax-free income flow for his retirement.
It's not tax-free income flow unless he borrows from it, but yes.
Unless he borrows from it. Correct. Right. So are there any rulings or IRS rulings saying that this is okay to do, or do you know of?
There's no rulings per se. There's rulings out there that suggest in other areas this type of strategy works, but the code sections that are pertinent are section 419 and 419 cap A. And they're classified as welfare benefit plans. And if you look at the rulings in that area, this type of strategy works for employee owners.
Okay. So when I hear the word welfare benefit plans, that sometimes has a negative connotation, but it's a positive connotation. Those have been around for quite some time.
They've been around forever, but that's just a code section 419.
Okay.
It's like a pension plan.
Right.
They're all pension type plans.
Okay. So what any size business this is good for? I mean, small, medium, I guess it's just for the person who can afford to do at a minimum $50,000 for 5 years.
That's correct.
Okay. And insurable.
That's correct.
Okay. They got to be insurable. What if they weren't insurable? Could you do a plan like you're a business owner? Could you do it underneath your husband if it was your woman in your business?
You could invest in like annuities or something that's not insurance also.
Okay.
It's just a way to set aside this amount of money for the owner in the future and get a current tax deduction.
But I think the tax-free benefits at withdrawal or distribution, if you borrow from an insurance policy, is better than a deferred account.
That's correct.
Yeah. And then plus, if you die during the course of it, you got a death benefit that goes tax-free to your
That's correct.
To your beneficiaries.
That's correct.
David, are there any final thoughts before we close out this episode?
The only final thought I'd have is most people are under the impression you can't deduct payments for life insurance. This is a way that owner employees can deduct payments for life insurance, which is a pretty good deal for them.
Okay. And to me, this is something that you don't want to practice at home. You definitely want to have a professional do it for you.
Yes.
And your company and you can get that done for them.
That's correct.
All right. Thanks for being with us, David. And thanks for listening to Wait What? Financial Matters That Matter. To get hold of David, please email me at eb@wait-what.biz. Our next episode will be Deron Anderson Bell, and she'll be talking about marketing and crisis communication.